The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, I'm Scarlett Fu.
And I'm Alex Steele. We're kicking you off to the closing bell here in the U.S. We are on the upside in a powerful way on what news?
It's kind of slim today.
I know, slim pickings for news, something you don't necessarily see during a Trump administration. So it raises the question, like, who's buying and why? The S&P up a full 1 percentage point. And it's not just overall stocks, it's actually ex-tech that's doing really well. The SPW, the equal weighted index, outperforming the SPX. VIX down, 10-year yield pretty much flat, and gold getting a slight bid, but off its highs. We now saw it over $3,000. And all of this to say is it feels like the market's coming down just a little bit, with equities finding their footing.
All right, what's the backstop, or where's the backstop more accurately? Treasury Secretary Scott Bessent says he is not worried about the recent slump in stocks, suggesting there is no Trump put in place at a time when there doesn't appear to be a Fed put either, with the U.S. Central Bank kicking off this week's policy meeting in wait-and-see mode. Now, the latest data points on the consumer are not exactly helping. Retail sales rose less than expected in February, while Forever 21 falls victim to inflation and stiff competition by filing for bankruptcy a second time. Later this week, we're going to get a glimpse of the extent to which consumers are pulling back spending when Nike and Carnival report. And Harvard leads America's elite schools in tapping the bond market. They're trying to lock in financing while they can as the Trump White House rolls back federal funding and threatens to raise endowment taxes. Harvard will certainly be spending more after saying it's eliminating tuition for families making less than $200,000. We've got all that and more coming up, Alex.
All right, but Scarlett, let's kick it off with the positioning in the equity market, right? Have we finally seen stability, and are investors buying the dip? So this takes a look at speculative net longs on S&P futures, and they increased the most. This is according to CFTC positioning, and they increased quite a bit just in the last week. And so that really gives some credence to the idea, Scarlett, that the algos are the ones trading the headlines. The funds are the one trading the headlines, but that the long money, the blob of money that's a lot more sticky, they haven't been selling the headlines. They're still holding firm. And if that's the case, that probably means we haven't seen capitulation. Does it mean that the stability then is real?
All good questions. So let's kick things off with Brenda O'Connor-Juanas. Brenda is Senior Vice President and Financial Advisor over at UBS. And Brenda, let's put that question to you. What are you hearing from your clients? Are they holding firm? Are they buying the dip?
So thank you for having me. Look, UBS still has a 6,600 on the S&P for the end of the year. But frankly, the conversation I've been having with my clients in the last week is about that bear case. We have improved our views or changed our views. So we have a 30% probability of a downside scenario. I would say that I think that the recession fears are slightly overblown, but how that translates into what clients should be doing is really protecting on the downside. So we're not stepping into the equity markets yet. We're doing things like looking to gold, alternatives, fixed income, and some structured solutions just to protect the capital in what will likely be a continued volatility period.
Okay, so the immediate emergency of the declines may have passed, but the all clear isn't there yet. What asset class are you looking to lead equities right now?
So fixed income is something that we're looking to. And Scarlett, what are the fixed income markets telling us? Well, you know, they are more dovish than certainly they were a few months ago. Look at what the markets are pricing in terms of Fed cuts, 70, 80 basis points. It's a lot different than what we saw in January. You know, the thing is here is that the fixed income markets are not always accurate. We saw that in 2023, we saw it in 2019, we saw it in 2016. They're not always predictive of a recession. We do not think that there is a recession at this point, primarily because if you look at the data is weak on the soft side, not necessarily on the hard data yet. And until we see that, we are not panicking. I mean, look at the retail sales numbers that we saw this morning, which you highlighted. They were in below consensus, but they were still positive. They were 0.2%. That is not recession territory. And so we still like fixed income. We think the 10-year will go to 4% by the end of the year. And in terms of sectors within fixed income, we like medium duration treasuries and we like high quality investment grade corporates.
Is that a call to then sell equities to go into fixed income, or is that just money on the sidelines going to fixed income?
So we are not selling equities at this point, Alex, and that's for a few reasons. I don't want to be crystallizing huge gains in my portfolios. Also, you know, with the VIX where it is now, just slightly above the 10-year, I think it's more prudent to look at protection strategies on the option side, structured note side, you can still get a lot of protection without leaving the equity markets altogether.
So to that point, what would your clients need to see to get a lot more skittish on equities? I was talking about the blob of money that is sticky, right? The long hold investors that aren't really doing that much. So you can't have that capitulation. What would bring that into the foreground?
I think you need to see the S&P below 10 or 15% here for, investors sitting in cash to get really excited. I mean, we did see some of those contrarian indicators last week that are indicating a buy. I just think we're too early. For equity investors, I also think particularly those in the U.S. might look outside of the U.S. for opportunities for a longer term perspective. I think, you have valuations that are more attractive in places like Europe and emerging markets. The U.S. is 16% of the global economy, but 65 to 70% of global markets. So I think that the rest of the world is under-owned. I also think the U.S. dollar comes in here in some regard. We know that the U.S. dollar is overvalued. By how much we can debate, but at some point we expect U.S. dollar weakening, which will be a tailwind to returns for U.S. domiciled investors.
Feels like it's going to be a waiting game between now and April 2nd when the next round of tariffs take effect and when earnings season really gets going as well. And we start to hear from the companies themselves on how they see things playing out. What do you suggest to investors in the meantime between now and then when there might be a little bit of a news vacuum and everyone's looking at a lot of headline risk?
Right. I mean, gold is something else that we're looking at. Gold is very different in terms of what I like versus last year. I liked gold more opportunistically last year. And look, the metal was up 30%. Gold is a natural place to hedge against some of this tariff concern, against any sort of threat of resurging inflation. UBS increased our end of year gold price target to 3,200 today. So there's a little bit of upside there. And also, if you tip into any of these negative scenarios, I would imagine that gold could be up $3,400, $3,500. I think also within the metal space, silver is attractive. Look, it doesn't have the same hedging benefits that gold has, but we expect the metal to be at $38 within 12 months. So that's another interesting place to be.
Okay, so we talked a lot about sort of the safety plays. Brenda, before we let you go, what do you do with large cap technology? That's really the underperformer today. Mag 7, sort of the loser, but the broader index doing really well. What's up with tech?
So tech is one of UBS's preferred sectors. Personally, I'm not stepping into this with fresh capital just yet. I think you need to see a little more capitulation. I do fundamentally on a longer term like tech, and it should be more immune to some of these tariff concerns. Also, if we see from the White House any sort of initiatives that's going to be stimulative to U.S. innovation, tech will outperform. From an EPS perspective, we think that the sector will be up 20-25%. I just think personally, I would rather wait another week or so to see more data come in.
All right. Again, part of that wait and see picture that's really forming right now. Brenda O'Connor Juanas, thank you so much. Brenda is Senior Vice President and Financial Advisor at UBS. We've got a big show coming up. On the close, analysts are sticking with Apple, even in the face of a recent sell-off in AI delays. We're going to get into why they think Apple is still as sweet as ever.
Plus, we get a read from Marathon CEO Bruce Richards on why the credit market is primed for outperformance.
And tariff uncertainty has the world on edge. We're going to speak with the president of the Council on Foreign Relations, Michael Froman, on what this means for the global economic order as we know it. All that and more coming up. This is The Close on Bloomberg.
Wednesday, the Fed decides.
People just want clarity. Business leaders want clarity. Investors want clarity.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
What do they need to see to have confidence in the forward trajectory?
Could our big surprise be a growth slowdown?
What's worse than an economic slowdown? An economic slowdown the Federal Reserve can't respond to.
Tune in to Bloomberg Surveillance, The Fed Decides, starting at 1:30 p.m. Eastern.
Wall Street now bracing for oil in the 60s. Goldman Sachs joining a chorus of banks cutting their oil price targets. The bank now calling for Brent between $65 and $80, that band there. Joining us now to discuss is Amrita, founder and director of research over at Energy Aspects. All right, Amrita, what's your oil price band and what's the low?
We are actually quite a bit higher than all the banks. I think it gives me a little bit of pause, but also a bit of assurance when all the banks are kind of talking about 50s to 60s. We are more like 75 to $80 for the simple reason that, look, actually the micro fundamentals for oil look absolutely fine. Stocks have been drawing counter seasonally for the first 2 months of the year, building a little bit now as is seasonal. We've still got sanctions coming, we believe, on Iran and Venezuela. We've already seen that being announced. The challenge, of course, and I think that's where the downside risk comes from, is global growth. Mm-hmm. A lot of the tariff policies and just generally a lot of the policies coming out of the US, the uncertainty it's causing, that's where I think the second half of the year could look potentially precarious if global growth slows down. Having said that, we are one of the lowest when it comes to our oil demand growth projections at only 800,000 barrels per day. So also at these price levels, supplies are just not going to rise. I think that was the message out of CERAWeek as well in terms of US supplies. I mean, that's now the floor, right? We need a minimum of these kind of prices if US is going to even hold flat.
Well, before we get to the US, though, let's go to OPEC Plus for a moment, because what we left out there in that explanation was the add-on of OPEC Plus barrels. And sort of coming at a time where, like, we don't know what that growth prospect is going to be. Do you think that they can add the increase and it's all okay?
For now, if you look at our balances, absolutely OPEC Plus can add barrels for a couple of months. We are showing draws pretty much starting May onwards. And I know that their balances show similar. And I think that's what gives them confidence. But remember, the group has said multiple times they can pause or even reverse this cut anytime if they feel that fundamentals are deteriorating, if they see signs that inventories are building. They will absolutely do that. And I think the market should see, and having seen that they've done that over the past couple of years, the market should at least feel assured about that. This increase was also as much about compliance. And, you know, we've seen this before as well. I mean, Saudi Arabia has said time and time again that these cuts need to be equitable. It can't be just them cutting and the others, especially with Kazakhstan and some of the other countries not complying. It needs to be that everybody carries the burden. And then, yes, they can all come together and pause if required.
Amrita, the Energy Secretary recently spoke at CERAWeek, and there were some comments where he was suggesting maybe $50 oil is a possibility. Do you see that as something that could happen in the next 5 to 6 months?
I mean, look, I wouldn't rule it out if global growth deteriorates. We don't think, we just published a piece today, for instance, we don't think even with the oil price drop that we've seen, the market's actually pricing in a recession. Our view is very similar to who you had earlier as well. Our view is that we don't think that there's going to be a recession imminently. This is more the optimism around a lot of the kind of Trump trades are coming out. And that's why we've seen the pullback across asset classes, and oil's kind of been dragged down by it. So, but if the market starts to price in a recession, then yes, there's a lot more downside to oil. I also believe at that point, OPEC will step in and stop the stem in oil prices. But initially, yes, it could go down. Again, not our base case, but that would be the only scenario how I could see prices going down.
Is $50 barrel uneconomic for the shale industry?
Absolutely, yes. And I think you've seen the likes of Harold Hamm, who's the father of shale, come out subsequently and talk about how, you know, some of the newer wells need prices well into the 70s, if not higher. I think fundamentally, the critical thing is that we are running out of tier one acreage for shale, which just means that there's going to be more gas and NGLs and not black oil. I think right now, if you get 200,000 to 300,000 barrels per day of exit to exit shale oil production, that's a good year versus, you know, 1.5, even 2 million barrels per day in the past. I think that's a paradigm shift.
Well, right. And then there you have areas like Guyana as well as Gulf of Mexico. So the deep water drilling that could actually be much more prolific than we would have thought 10 years ago. But that probably requires a higher oil price.
Absolutely. And I think, look, 2025, let's say, you know, we do average in the low 70s or even late 60s for argument's sake. 25, you won't necessarily see the biggest impact, maybe second half of the year. But 26 is when you really start to see the negative impact on production. We've already seen, by the way, Brazil, which is supposed to be a big growth story. The first 2 months, productions come in disappointed. Even at these price levels, exactly like you say, Alex, like these deep water facilities and just these fields require a higher break even, and decline rates are already starting to accelerate in some areas. And I think that's going to be the thing that catches this market out.
Yeah, that is such a great point. So in theory, is drill baby drill a misnomer? Is it like gas baby gas, or is it like off water baby off water? Like, what is the best way for us to think about what the U.S. needs to do to monetize its energy production?
So drill baby drill can, of course, refer to gas and NGLs as well. You're drilling, it's the same well that gives out everything. I think it's the way we phrase it is that you can get, people are talking about 3 million barrels of oil. It's more like it's 3 MBOED, right? It's oil, 8 million barrels of oil equivalent, and you're going to get it in gas and NGLs. I think that's where, the nuances lie. Yeah, you can drill as much as you want. You're just not going to get the black oil. I think that's going to be the biggest difference, especially if you do start to see sanctions tightening on Iran. We've seen some of the kind of comments on the Houthis earlier today. And of course, Russia, Ukraine tomorrow is the talk between Trump and Putin. And if you don't see Russia cooperate, the question is, does the U.S. actually tighten sanctions on Russia as well? So there are a lot of those uncertainties still ahead, which could actually tighten the markets rather than loosen them.
All right, Amrita, founder and director of research at Energy Aspects, joining us from London. Thank you so much for your time today. And Brent right now trading at $71.09 and WTI just above $67 a barrel. Coming up, we're looking at shares of Apple on the rebound today after having its worst week since 2022. But some on the street still see it as a safe haven amid market volatility. That's coming up next. This is The Close on Bloomberg. It's time now for our top calls. A look at some of the big movers on the back of analyst recommendations. And first up, a sell rating for Reddit as Redburn Atlantic starts coverage of the social media platform. Reddit saw a huge boost in user activity in the months following an algorithm change at Google to push Reddit posts to the top of search results. But the analysts warned that if Google giveth, user growth will stall and even decline should Google taketh away. We also just got a report a few moments ago from Reuters that Google is expanding its partnership with Reddit. You can see the shares there up almost 7%. Alex?
All right, so I'm taking a look at Norwegian Cruise Line. So JP Morgan analyst Matthew Boss lifting his rating to overweight from neutral after seeing reassuring signals from its investor conference. Boss says Norwegian indicated that demand would be stable while factoring in uncertainty from the geopolitical and macroeconomic environments. Those shares up almost 6%.
And finally, Netflix upgraded to buy from neutral at MoffettNathanson. The analyst highlighting the streaming service's ad-supported tier, which he says has unlocked an incremental addressable market for subscribers. He also has more confidence in Netflix's ability to expand its profit margins. You could see Netflix shares up about 5% in current trading. And those are some of our top calls.
What's really interesting about the market today, Scarlett, is it's actually the equal weighted index. It's outperforming the S&P in part because tech is underperforming. So that Mag 7 underperforming in no slow part by Tesla. That stock up by almost 5%. But Nvidia is still down by about 1%. Google's down by 0.4. I mean, Microsoft and Apple are up, but just slightly. But it's interesting to see that tech being the weakness today.
Yeah, when you look at the S&P 500, and I know it's not the broadest measure of U.S. stocks, but certainly broader than the NASDAQ 100 or the Dow Industrials, 469 names gaining right now, 32 names on the decline. And as you mentioned, the Mag 7 not doing as well. Lower right now, mainly dragged lower by Tesla and Nvidia. Only Microsoft and Apple hanging on to some gains, but these gains are still pretty minor.
Right. So then the question is sort of, does tech become a drag from here? And is the rest of the stock market, we've been wondering for quite a long time, going to survive and be strong enough to outweigh any weakness that we've seen in tech? And if so, where does that catalyst then come from? If you still have economic uncertainty, you looked at the OECD today, downgrading the U.S. growth forecast, looking at Canada, have a growth scare as well, Mexico in a recession. That's not going to be necessarily good for the other stocks, right, at the end of the day?
There haven't been that many catalysts in intraday trading today. You look at the price action on the S&P 500, and it's been a steady climb higher since 1 p.m. I mean, we've leveled off, but in part that's helped by relative silence on tariffs today. We haven't had a lot of headlines in contrast to the last couple of weeks.
Also, I think it was Mike Wilson also pointing out that the dollar, for example, the weaker dollar that we've seen could actually provide a boost for S&P companies, those especially that are quite global. So there are some things out there that could actually do really well. And as we've seen in the hard data, things haven't been bad yet. right? So it's sort of the expectation through sentiment, but when it feeds into the hard data is a totally different question, and we have not yet seen that. Just look at those retail sales numbers.
Yeah, but to your point, the soft data has not been looking good. Empire Manufacturing, which is a survey-based report, coming in with a read of -20 today.
So that was bad. Yes.
The expectation was for -1.9.
Okay, sure. That wasn't so great, but still, I mean, come on. Is anyone going to trade off Empire Manufacturing numbers?
No, but it adds to the evidence from people's perspective that this idea that we weren't going to have a recession just 3 or 4 weeks ago now is becoming more and more of a thing. The Atlanta Fed GDP now plunged at the end of February, and initially there was a sense that, oh, who can believe this? It's overkill. But now more and more you're hearing a lot of references to it in conversation and certainly in people's research.
All right, well, let's get to more on this. Taking a look at those big tech companies, Mag 7. Shares in Apple, example, fell nearly 11% last week, making the stock's biggest one-week slump since November 2022. But taking a look now, that stock is up by about 0.4%. Joining us now for more on the Mag 7 is Mandeep Singh. He's at Bloomberg, a senior technology analyst. Mandeep, thank you so much for joining us. The weakness today is in tech. Does that continue, you think?
Well, I mean, when you look at the Mag 7 stocks, every stock has got its own nuances. In the case of Apple, I think the fact that they still don't have a large language model and everyone is unsure what their strategy is when it comes to Gen AI, that has been an overhang. Look, they've been talking about new product cycle, this and that, but ultimately you need a large language model as a hyperscaler, and I think that's what is hurting Apple. The other ones, I mean, NVIDIA obviously has a big catalyst in the event tomorrow, but when it comes to the Microsoft and Alphabet, they've got their own problems. Alphabet, we know everyone is attacking the search business. So I would say you have to look at each of the names separately, Tesla and so on, yeah.
And in contrast to Microsoft or to Alphabet, Apple is very much a consumer electronics company, so it is vulnerable to tariffs in a way that the software companies, for instance, aren't.
Yeah, look, I think with tariffs, I mean, Apple and Tesla probably are the most exposed here because of the China exposure, both to their cost side as well as, the fact that they generate a decent amount of revenue in China. But in the end, nobody exactly knows how tariffs is going to hurt the gross margin profile because we have had some flip-flops when it comes to tariffs. And look, in the end, companies won't really, make adjustments in the short term. Like, these are long-term decisions. So you're not going to wait for a 4-year cycle and then change again. So that's the overhang.
And in the past, Apple won carve-outs from the tariffs. Do you think that's going to happen this time around?
I mean, I would think so. I don't think this administration wants to hurt the American businesses. So I would assume, if they have a sizable exposure to the cost side, Apple should be excluded from, any such impact, but we don't know. That's the uncertainty.
If you're paying $1,200 for a phone, like what's next for $50 at that point, right? It's still $1,200. All right, Mandeep, thanks a lot. Really appreciate Mandeep Singh, Bloomberg Intelligence, senior technology analyst. All right, coming up, we're going to take a look at those cracks forming within the credit market with Bruce Richards, CEO and chairman of Marathon Asset Management. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Scarlett Fu.
And I'm Alex Steele. Definitely looking at some upside right around the highs of the session for the S&P. Scarlett, Citi was out with a note saying that the FOMC day, you're looking at the implied move for the S&P at about 1.2% to the up or downside, which is actually elevated versus recent meetings.
Things feel really calm today, and I know saying that will make it so that it's not calm anymore, but
just blame her when that happens.
We've seen a steady move higher in the indexes throughout the afternoon. It feels like there aren't as many headlines. I know that there's a lot of talk about how there is no longer a Trump put based on what Treasury Secretary Scott Bessent said today, and there's not necessarily a Fed put, but people are still coming in seeing some value here.
Yeah, it's interesting when you talk about puts, sometimes they say, well, there's not a put at 10%, but maybe there's a put at 15% or 20%. Is that the kind of put we need to see to sort of move along in any sort of trade policy? One area of the market that's causing some confusion here is corporate debt. So potentially the popularity is showing some signs of fading due to trade wars between the U.S. and other nations. So Bank of America says that cracks in the credit market that appeared last week are culminating into a fracture this week. Joining us now in the studio with more on this is Bruce Richards, CEO, co-founder, and chairman of Marathon Asset Management, which has more than $23 million in assets under management. Bruce, good to see you.
Nice to see you, Alex.
I'm guessing you're going to say no, but are there lots of cracks in corporate credit, and is that warning us of danger to come?
Well, you know the right guess, and so correct again.
So that's a no, but why?
So here's what I think about credit. credit markets are behaving really, really well. Volatility on equities out, a good from 15 to 25 vol. And equity markets haven't traded down 10%. So what have we seen in credit? IG is out 15 basis points. High yield is out 50 basis points. One might say from the tights, all-time tights, that's too much. But look at price. The price hasn't budged. HYG, which is the ETF for high yield, the price was 79 on February 19th when the S&P was at all-time highs of 6,147. Today, also 79. The price hasn't budged. So when investors look at their book and they look at no price deterioration in credit, and then you go to private credit, and in the private credit market, we're having a really good time putting all this capital to work, generating these 12% returns. And so what's really happening down beneath is people rotating out of equities, out of growth in particular, which is why you don't see kind of this bump in the marketplace for Mag 7 while the other equities are rallying, and you're seeing money come into credit, supporting the credit market. So the credit markets are incredibly stable. Vol's out a lot. You think high yield spreads would be out 100 basis points or more in this type of vol, but they're not. They're holding in very well. In fact, price hasn't moved, either for loans or bonds, in any kind of meaningful way. And
so we don't need a Fed put or a Trump put for this to work for you?
Not at all. We can talk about the put in a second, but not at all. I think, what's happening right now is policy measures coming out of Washington, both with respect to tariffs as well as government expenditures, is going to result in the economy growing not at 2% or 2.1%, which was what the blue chip economists and the Fed had thought originally coming into this year, but growing more like 1 to 1.5%. Because it's going to feel like austerity that we've seen in Europe for years and years without the big government expenditures as they pull in the reins of the big deficits. And so as long as the economy grows at 1%, credit markets are dancing and singing, having a great time. Meanwhile, equity markets are suffering, and they're not going to show a lot of appreciation, going to show a lot of volatility through this transition period. So I think credit is the place to be. It's the golden era of credit. As it respects to the Fed put or a Powell put, no, I don't think we're going to see a put down 10%. I came on, at the beginning of the year and said equities would be down 7% this year, 10% from the highs. We definitely see a correction after back-to-back 25% gains. It's exactly what we had. And so a correction and a bounce off of that level and that level holding, there's no correlation for that to recession. And you'd have to see a recession really to have crack in the credit markets, or recession to see a Fed put. And so the Fed's meeting this week, not a shot they're going to ease, and they're not going to talk about easing at this point because inflation's still a little bit too firm for them. And the economy may slow a little bit, jobs may slow a little bit or inch higher, but that won't have any impact really on credit. Having said that, you'll want to avoid certain sectors and lean into other sectors, and that's what we're doing right now in our book.
Okay, let's talk more specifically about where you're leaning into and what you're avoiding.
So I'd be avoiding what you know to avoid, which is the autos, right? And there's some downgrades that are probably going to be happening there with respect to credit ratings, as well as some earnings pressure you'll see in the autos. You'll see that some pressure as well in the home builders and the airline. The airline stocks are down 30%. We're doing a lot of aircraft leasing, and we've done a bunch of engine aircraft leasing in a private ABL program. And so we're very prolific right now, but not the unsecured debt, and I would avoid the equity at this point. So what we're leaning into, we love pharma, and specifically within pharma, because it's not a cyclical business. And I don't know if you've been following the story, but Endo filed for bankruptcy. Mallinckrodt filed for bankruptcy. They both emerged from bankruptcy and last week merged as companies. And so we own a lot of the debt that is now the equity of the company, and we think it's the cheapest equity in the world in the pharma space, because today, in the stock market, you can buy it at a 5 times multiple, a big discount to the other farmers, and it's printing cash. $1.4 billion of EBITDA on a pro forma basis, generating nearly $1 billion of free cash flow. And we love that company on a combined basis. It's growing. Its debt is only 2.3 times debt to EBITDA, which is a very small amount of debt for a company like that to emerge from bankruptcy. So it's incredibly healthy. And so I like the debt, but I really love the equity. That's something we're going to have in our position for a long time to come, because it's a tremendously undervalued company. So that's one type of special situation that we're buying. We have a couple other situations in the marketplace that I can't share with you now, maybe next time on the show, because we're in the market accumulating it, today, last week, and in the coming weeks.
You said you're avoiding autos, given the tariff situation. Makes a lot of sense.
Yes.
They're also exposed, of course, to consumer sentiment and consumer demand. And there are a lot of question marks about consumer demand, given the uncertainty, given the job picture. How are you looking at the consumer sector overall? What would present good value right now?
There's a lot of good value in the consumer sector. So while I mentioned the home builders, home mortgages, for instance, second liens, HELOCs, tremendous value because it's secured by the home, and we've seen a lot of appreciation in home prices. And so although I think the home loan is a bit stretched, there's so much value in what we're buying in the loan market because of the LTV attachment point. If we can be at 50, 60, or 70% LTV, we have a huge margin of safety. Now, on the other hand, I would be avoiding or downplaying some of the consumer unsecured debt. And there's installment loans and debt consolidation loans, and got to be very, very careful. It's a bit of a trap sometimes because they offer very high yields, but also very high loss rates.
Right,
so on a loss-adjusted basis, one might not make the kind of return they expect to make. So we're downplaying the consumer overall, but we're leaning into the loans that are secured by property as opposed to loans that are unsecured.
So where does that leave like commercial real estate, for example?
Very, very esoteric, very, very idiosyncratic type of investments that we're making. So the esoteric part might be the fact that we own a huge amount of Freddie K's, which is the multifamily tranche, the lower tier tranche of multifamily loans that have been sold from the Freddie Mac's balance sheet. And so we love that. We have a huge position in that, and we're not letting that go because it's throwing off enormous cash flows. And so we like that. In terms of real estate lending, look, we're still being very cautious to office because it's going through a transition that will take years to go through. I think retail, you've seen kind of the big pig go through the python and see now, years later, who's been Amazoned, right? Who's been able to survive, what properties have been able to thrive, and what properties. And so I'd actually be leaning a little bit into quality, high yielding, cash flowing retail. But we always love the consumer, so we always love multifamily. And we love our elderly, so we're putting lots of dollars into senior living as well in terms of where we're making our commercial real estate loans.
In other words,
stable cash flow loans in commercial real estate is the answer to that question.
Yeah, you got to do your homework from a bottoms-up perspective then. Bruce,
exactly.
Always appreciate your coming on. Bruce Richards is CEO and chairman of Marathon Asset Management. Coming up, shares of Affirm are down on news that its competitor Klarna will take over as the exclusive provider of buy now, pay later at Walmart. It's our stock of the hour. This is Bloomberg. All right, we're looking at shares of Affirm falling as much as 7% after its competitor in the digital payment space, Klarna, will take its place as the exclusive provider of buy now, pay later services for Walmart. News of this partnership comes days after Klarna filed for an IPO in what could be one of 2025's biggest company listings. Here now to discuss is Bloomberg's Bailey Lipschultz. So Affirm taking a bit of a backseat here, it loses its competitive position, at least in Walmart.
At least in Walmart, especially around OnePay. I was talking to a few analysts who were saying it's kind of muddy just how the Walmart kind of ecosystem for buy now, pay later is going to shake out, because this is OnePay, Walmart-backed OnePay offering this. There still are other options to utilize different kind of services. So Affirm does still have kind of some longer-term partnership with Walmart. It's still kind of early days. Affirm basically downplayed the volume that is driven from this. But as you mentioned, now down about 7%. I think that's why it's clawed back. It was down as much as 16% this morning. A lot of kind of investors trying to get a better grip on what this does mean, but it is really indicative of how quickly things can change as it relates to partnerships for buy now, pay later.
Dumb question. Are they that different?
The two companies?
Yeah.
No. Okay, for all intents and purposes, they're direct comps. That's why there's actually been, it's interesting, I was talking to an investor this morning who said, okay, you look at the Affirm pullback today, now down 6%, still down 43% from a high last month. That actually could be bad for Klarna when they're meeting with investors, because at the end of the day, if you're a prospective buyer, you're saying, well, this is the multiple I can pay for a firm. They're already public. Why do I want to pay equal or a premium for you? So it's interesting. We do see this from time to time. Companies come out with news. For another company, CoreWeave announced their partnership with OpenAI days after flipping public. So this does happen. It gives the company something to talk about on the road. But there is so much volatility right now that the path forward for Klarna is going to be interesting.
When is Klarna likely to list? What kind of time frame are we thinking?
15-day seasoning period from when you flip. So they flip Friday. The earliest they would typically launch the roadshow would be, call it March 31st, April 1st, and then you would price normally a week after that. So we would be looking first full week in April would be the most expedited time frame. Again, volatility aside.
Right after those April 2nd reciprocal tariffs. So that'll be a fun market tape. All right, Bailey, thanks a lot. Really appreciate that. Bloomberg's Bailey Lipschultz joining us on the Stock to Watch into the close. All right, about 15 minutes on the close of trading. Melissa Brown, Managing Director of Investment Decision Research at Simcorp, will be joining us. All right, let's take a look here, Scarlett, at the market. We are right around the highs. The S&P still holding up by about 1%. The NASDAQ up by 0.7, but really it's the NASDAQ 100, the Mag 7, led by Tesla, that's been the weaker spot in the market.
And to your point, the S&P Equal Weighted Index up 1.6%. Russell 2000 also outperforming, gaining 1.33% as well. Investors definitely rotating out of those big cap tech names.
Yep, and into the cyclicals as well within the S&P. Energy really outperforming on the day. This is Bloomberg.
I would say that I think that the recession fears are slightly overblown, but how that translates into what clients should be doing is really protecting on the downside. So we're not stepping into the equity markets yet. We're doing things like looking to gold, alternatives, fixed income, and some structured solutions just to protect the capital in what will likely be a continued volatility period.
That was Brenda O'Connor-Juanas, Senior Vice President and Financial Advisor at UBS, kicking off the show. She talks about a volatility period. We're not seeing it today necessarily, but certainly in the last couple of weeks has been nothing shy of a very rocky road.
No, the VIX lower. You got bonds actually in the back end having a little bit of a rally here. Also, the front end did not know what to do today. And look at the sectors that are actually doing well. Energy, the best performing sector within the S&P. That and real estate. The Russell doing really well. The Equal Weighted Index doing really well. The NASDAQ overall doing okay, but the Mag 7 not. And that's just kind of weighing on the tech index. Just look at Tesla, the worst performing stock within the Mag 7, off by over 4%. See, I have to say, are we in a place where the Mag 7 is no longer a thing? Because they're moving so idiosyncratically now with different issues.
Maybe. I mean, Tesla's kind of its own thing, right? And Apple is also its own thing because it's so much more exposed to tariffs along with Tesla than some of those other names. So yeah, perhaps.
We need a new acronym.
Well, it'll take a while before we can come up with that.
Remember, not for us.
What was the previous one that was happened during the big meme stock period?
What was it? It was not FOMO, was it?
No, it wasn't. I'll come back to that. All right, for more market analysis, let's welcome Melissa Brown, Managing Director of Investment Decision Research at Simcorp. So I guess that's a good place to start it off, Melissa. Is Mag 7 even a thing anymore, or have the drivers for that group really become something so idiosyncratic that you can't lump them together anymore?
I think that's a really good point, and that's very true. We have seen, correlations, between many stocks, not just those stocks, come way down.
Yeah.
And so, I think that's a good point.
FANG.
Oh,
that's what it was.
FANG and Famiga. Remember?
Yes.
No.
MAMA. It was MAMA once the meta thing happened. Anyway, yes. I'm glad we got there.
There's also the European granolas, by the way.
Yes. That felt really important. Okay, so if tech is idiosyncratic, so put that aside for one moment, and we're taking a look, say, at the S&P and the Equal Weighted Index right now, what does that tell you about stability or not in the market?
Well, I think the good news is probably that the market is broadening out. That we're not just dependent on a few names to be leading the market upward. But the problem is that it's broadening out, but it's not going up. So it's not that you've got all these smaller names that are going up. It's, again, you have, kind of uncorrelated performance. And so it's not, it's probably better news for an active manager, someone who's trying to beat the market. But for the investor in an index fund, it probably doesn't make that much difference.
So a correction is a correction. We got the correction in the S&P 500. We got the bear market in the Mag 7, and we're kind of just bouncing around those levels, coming off of it at times. Where does this leave us in terms of looking ahead to earnings and kind of figuring out whether the forecasts that we got from companies in the first quarter were certainly cautious, but were they justifiably cautious, or just, let's just be super conservative cautious?
They were probably, let's just be super conservative cautious, but I do think that since the first quarter, this fourth quarter reporting season, the landscape has changed a lot. We're seeing lower consumer confidence. We're seeing lower small business confidence. All of those things that really are suggesting that we're going to need to look very closely at earnings, because it does seem like they will tell us a lot about the impact of inflation and what the consumer is doing as well.
Right, and like when that happens though, because it could take months for us to get a handle on it, right? It wouldn't even be next earnings season. How do you manage the risk?
Well, managing risk, is always tough. We provide risk models, so we believe in using models so that you can really understand what's driving the volatility in your portfolio, how stocks are correlated or not correlated, as we've been discussing. But I think it's particularly important to manage that risk. Maybe you just want to make sure that any risk you're taking is commensurate with the return that you expect. And hopefully you're right with your return expectation. But that's really what we would counsel. Don't take unnecessary risk.
Does that mean that it's a better bet right now to look at overseas markets, to look beyond the U.S., even if it's for the short term until things settle down here?
Well, certainly for diversification reasons, yes. The overseas markets have done well. They've done
much better. Has easy money been made there?
They were below the U.S. for so many years that I think maybe the easiest money has been made, but I think there's probably still opportunity there, because even to get even close to the return that the U.S. has had over the past, say, 3 years, there's still a long ways to go.
When we take a look at sort of who is in the market doing all the things, right? You have like hedge funds, you have the sticky blob money, the long-only investors, you got retail, and then you have the funds. And I'm just curious from your perspective, sort of where positioning is right now, like who's still like in the market and who's sort of tapped out.
Well, it's interesting. There's been, with the market going down, a lot of discussion in the media about 401ks, and people look at your 401k. Don't look at your 401k.
Never look at your 401k.
Right? Yeah, I subscribe to that. But I think we are seeing some of the selling action on the part of the retail investor who's getting scared. Institutional investors can't really just up and sell when they want to. Hedge funds are hedged, so the direction of the market is much less important. So I really think the retail investor is, who's kind of driving what's going on.
Do you think we've seen a shakeout from the sell-off the last couple of weeks? I mean, one thing that everyone observed was that it was very orderly, and it didn't seem like there was a flood of forced selling. Do you think that that's over with, that we're not going to get detritus of that later on?
Well, I think it's going to depend on data releases and what do the inflation numbers look like? What do, manufacturing surveys and so on? What does all that data say? And then also, what does the Fed say after the meeting this week? And, the word that I'm most scared of is stagflation. And I think that could really drive maybe a somewhat less orderly sell-off.
Which is kind of what the OECD was hinting about too, right? Lower growth, higher inflation. Melissa, thank you so much. Really appreciate your time. Melissa Brown, Managing Director of Investment Decision Research over at Simcorp. Again, you have markets right around the highs of the session, but as Scarlett, you've been pointing out, the tape has been relatively calm today considering the volatility that we've seen in the last couple weeks.
And if you just want to look at volume as well, in the Dow and the S&P, higher than average, in the NASDAQ, lower than average. I know Gina Martin Adams doesn't put a lot of weight into all of that, but I always find it's interesting, especially when we're talking about the Mag 7 not doing as well, not being this one thing that everyone just gravitates to.
Agreed. That's definitely interesting. And Mike Wilson, I should point out, over at Morgan Stanley, saying that this could be a tradable rally could be likely. I don't know. Maybe we are seeing that right now. But he still thinks that volatility will persist. All right, we are moving closer to the closing bell. We have full market coverage right here on this Monday on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
About 2 minutes away from the end of the trading day, I'm Alex Steele alongside Scarlett Fu here to help you take you through the closing bell in a global simulcast. We're joined now by Tim Stenovic, Emily Griffeo, bringing together our Bloomberg television, radio, and YouTube audiences worldwide to parse through the crucial moments of the trading day, and definitely statewide, because Tim, you're in San Francisco?
Yeah, we're going coast to coast. We're all over when it comes to the closing bell here this afternoon. You guys know it's like not even 1 o'clock yet here.
Is that
in
weird
California.
for you? Is this like really crazy for you right now?
This seems totally weird for me.
Yeah.
This seems totally weird for me. What I will say is that as far as crucial moments of the trading day go, I kind of thought that investors would be on the sidelines on a day like today, where we're, that 2-day policy meeting from the Fed kicks off tomorrow, and the investors are waiting to hear from Jay Powell on Wednesday. But no, we saw a pretty broad-based rally. It's given up some of its steam, but still, it's pretty broad-based.
It's pretty broad-based. You look at the bond market, it's not providing much clue as to what's going to happen next, right? There's some movement on the short end with 2-year yields moving higher, but everything else is just kind of just sitting there unchanged. Not a whole lot of tariff headlines, which I think, at least for journalists, we can be grateful for. It just kind of slows things down a little bit. And we know that April 2nd is still the big day to watch for.
Yeah, and it's interesting also to see small caps performing higher. We have a little bit of a rotation with the biggest mega cap tech stocks falling today, and yet the Russell 2000 up over 1%.
Yep, I've been saying all morning to the equal weighted index, also outperforming the broader S&P. We don't usually see that all the time. Should point out, though, the city still sees a 1.2% move for the S&P on Fed day to the up or downside. That's a little bit more than expected. But for now, we're seeing a rally, though, off the highs of the session. We're still settling out here, but looking at the S&P up by about 0.8%. The NASDAQ underperforming, just up 0.3%. Dow Jones Industrial Average up by 0.8%. And as Emily was just discussing, the Russell 2000 also looks to be settling out up by over 1%, you guys.
Well, you had more than 90% of the stocks in the S&P 500 move higher today. Only 42 stocks moved lower, whereas 459 stocks in the S&P 500 moved higher. A good day for me to be doing gainers and Emily to be doing decliners.
All right, let's give Emily a little bit more time to look for some decliners. I'm going to show you what's happening on the IMAP, and you can see it is a sea of green there. There is some red, and that's mainly the consumer discretionary sector, which encompasses home builders, automakers, and retailers, and the weakness really is in the auto sector. That group is lower, so that's a drag on the consumer discretionary overall. The best performing sectors, real estate, consumer staples, and energy, all up at least 1.5%.
Hey, I want to go to some of the gainers that caught my eye today. There were certainly no shortage to choose from, starting with shares of Intel, higher today by, we can go ahead and round that up, 7%. Intel's incoming CEO, Lipschultz, has considered significant changes to its chip manufacturing methods and AI strategies. This is according to a report from Reuters. They cited 2 people familiar with the matter. A few things here includes restructuring the company's approach to AI and staff cuts to address a middle management layer, revamping the company's manufacturing operations. An Intel spokesperson told Reuters that Tan will work closely with the leadership team to position the business for future success, though declined to provide details or make him available for an interview. Shares were up as much as 8.7% today before giving away some of those gains. The stock, though, up, wow, close to 30% so far this year. And yes, it is outperforming NVIDIA just this year. Also, shares of Robinhood finished the day higher today. The company unveiled a hub inside its app for retail traders to bet on the likelihood of certain event outcomes. Shares higher by 7% today. This hub launched today, and it's going to facilitate bets for what the upper bound of the federal funds rate will be in May and outcomes of the upcoming March Madness college basketball tournaments. They're doing this through Kalshi, which is a regulated exchange that's drawn formal questioning from the CFTC over how its sports event contracts are in legal compliance. Still, investors setting shares higher.
What Taylor Swift wears at the Super Bowl? Like, is it that kind of thing? Like, how many times she laughs? Like, is it that?
Yeah, I don't know how sort of detailed they're going to get with that stuff. They ran into some problems with this ahead of the Super Bowl last time, and they ended up pulling it from their app. So, but again, now we're in sort of like this different regulatory environment. Plus, I think Kalshi has some involvement. I think Donald Trump Jr. is actually on Kalshi's board now. Oh. So there is some involvement there as well. Finally, this is for Carol because she's not here today. I wanted to do an entire index. It's the NASDAQ Golden Dragon Index.
Good shout out.
It's higher by 4%. Chinese stocks in New York breaking out today. Investors are looking at the nation's plan to boost consumption and mold this AI model released by Baidu. NASDAQ Golden Dragon Index higher today. China did put out guidelines to revive consumption by boosting people's incomes and set out other measures, such as stabilizing the stock and real estate markets. Golden Dragon China Index higher by 4% today.
All right, and for those decliners, I did have to look a little bit to find them, but Affirm was a big one. The buy now, pay later company slid as much as 16%, but closing now about 4% lower. And this was on news that rival digital payments company Klarna is set to displace it as the exclusive provider of buy now, pay later loans for Walmart. And it's all coming a few days after Klarna filed publicly for a U.S. IPO in what could be one of the year's biggest financial company listings. Now, these other two companies, I don't know if you guys have heard of them, but Nvidia was down as much as 3% today. Not as much on fundamental news, really, but it is the first day of its much anticipated AI conference for developers, which will be going on for a few days. Tuesday is when CEO Jensen Huang will speak about NVIDIA. Shareholders now, I guess, hoping that he can inject some much needed optimism and momentum into that stock, which again was down, closing about 1.8% today. And then finally, Tesla. We talked about how the indexes were higher. Tech stocks broadly, when you look at the NASDAQ 100, were higher, but Tesla was lower. Again, was there really any fundamental news? Not quite sure, but I'll give you some perspective on this stock because although it was lower today, the shares were up about 8% in the past 5 days. And that stock is up 46% in the past 52 weeks compared to an 11% decrease for the Bloomberg designated peers of this company. So that's just some perspective for you, even though Tesla was lower today.
All right, I'm taking a look at the bond market, guys. It was a weird day, and I'm saying that because the front end couldn't seem to understand which way it was going. So at one point, yields were up 4 to 5 basis points, and then they were down, and then they were flat, and now they're ending up by about 2 basis points. You did have some selling, though, in the back end consistently with yields a little bit lower. Remember, we got those retail sales numbers that missed but weren't terrible, so take that for what it is. And the Empire Manufacturing number that got Scarlett all riled up, down 20. She was very upset about that. So
it's
there's
a big
that as well.
Number.
It's a big negative number, but either way, sort of steady as she goes when it comes to the bond market, you guys.
How about a nice cold can of Stillers? How does that sound to you?
Stillers? Explain.
It sounds either like a Ben Stiller or a beer. What is it?
It's a Ben Stiller. So you've heard of Poppies, or Poppy rather, and Pepsi's going to acquire the soda brand Poppy for nearly $2 billion. Now we're learning that actor and producer Ben Stiller is planning to launch a low-sugar soda named Stillers. This is according to people familiar with knowledge of the matter. He's held talks about raising funds for the venture. The plans are still not finalized, and they could change. But this low-sugar soda is so hot right now.
I don't know. I feel like, can I have a Stiller? Totally works in a bar. I feel like that's actually a really smart marketing
the funny thing is that he's going to star in the advertisements promoting the product. So that alone will make it interesting because anything Ben Stiller's and I don't know. I tend to not be able to look away.
It sounds like
I kind of love.
I feel like
he's having this moment.
I feel like he's riding on, maybe brand familiarity. That it might sound like, oh, I want a Stella. But then you order a Stiller.
Interesting.
There you go.
Confusing or good marketing? Hard to say at that point.
Let me just jump in here because we do have some breaking news. Alphabet is in fresh talks to buy Wiz for $30 billion. This is according to the Wall Street Journal. This is the cybersecurity startup. Again, it is back in discussion talks to acquire this cybersecurity startup. According to the Journal, the stock not moving a whole lot right now in after-hours trade, but we will continue to keep an eye on these developments.
All right, guys, here's a story that caught my eye because we all talk about how much we can quantify AI is actually making. Well, now we can kind of quantify what we, everyday people, are paying for AI products. So apparently, over 35% of Americans reporting using AI-enabled products at least once a week, and many users are actually willing to pay for AI apps, and some paying up to $200 a month for unlimited access to some advanced models, other paying about $10 a month for apps like Midjourney and Canva. But the point is, people are paying and using it.
Why would they do that when ChatGPT has a free version?
I don't know.
Because the subscription version allows you to use it as an agent. So if you want to get a restaurant reservation or book plane tickets, you can actually have ChatGPT do that for you. It's just going to cost you $200 a month.
Yeah, I'm not
cheaper than
that.
a butler. right?
Cheaper than a butler. But also, you guys, think about
is.
booking vacations is such a pain. Like, if you had the money and could outsource that, like, you would totally do that.
But then you have to involve, like, the ChatGPT bot to know your, frequent flyer miles and your passwords and all of that.
That's what you're paying for. That's your $200 a month.
I love it. Okay, well, we're going to keep human from here on out, at least according to us for now. But that is going to do it for our cross-platform coverage of the market close on Bloomberg Television, Radio, YouTube, and Bloomberg Originals. We're going to be back tomorrow, same time, same place.
All right, we're going to continue here on the close because coming up, U.S. trade wars setting the world on a path to slower growth. That, at least, is according to the OECD. We're going to discuss this with Michael Froman. He is the president of the Council on Foreign Relations next. This is the close.
The countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
Welcome back to the close. I'm Scarlett Fu.
And I'm Alex Steele. Let's take a look here at where markets closed out the day. So for the S&P, it was a win, did close off the highs of the session, however, but closed up by 0.6%. We've now risen for 2 straight days for the S&P. That's actually the longest winning streak since about a month ago. So go figure. It's been a really tough couple weeks. VIX calm, 10-year yield calm. Gold actually closing right around 3,000. So that's not calm. That's definitely sort of a safe haven move, a risk-off bet. But you can see stocks and gold kind of moving in the same direction today.
Yeah, that safe haven trade for gold has been playing out for a couple of months now. Let's take a look at some of the day's big movers, and we're going to start with Intel, the biggest gainer in the S&P 500. The incoming CEO, Lipschultz, is considering making significant changes to its chip manufacturing methods as well as AI strategies. That's according to Reuters. That stock up almost 7% on the day. And Affirm, a big decliner here, although closing off its lows of the session, it did drop as much as 16%, so it's really pared some of that loss. The buy now, pay later payments company is being replaced at Walmart by rival Klarna. Affirm actually did say that its program with Walmart only made up about 5% of its gross merchandise volume and about 2% of its adjusted operating income in the second half of last year, but the headline was enough to send it lower. All right, let's talk about trade, because U.S. trade policies are setting the world on a path to slower growth and higher inflation, at least according to the OECD. Take a listen.
Well, on a country-by-country basis, I mean, the biggest impacts that we see are in Mexico and in Canada, for obvious reasons. But if I just go back, I mean, at a global level, we are downgrading our growth outlook for this year by 0.2% down to 3.1%, and next year by 0.3% down to 3%.
I'm pleased to say here now to discuss all of this is Michael Froman. He is president at the Council on Foreign Relations. Michael, good to see you here, and congratulations on the new post.
Thanks very much. Good to be here.
So when it comes to tariffs and trade overall, President Trump seems to have one ultimate goal, which is to bring production back home to the U.S. But that's going to take years, if not decades, to really bear out. In the meantime, there's leverage, there's revenue. How much of that is really at risk given the on-off nature of the tariffs that he has imposed so far?
Well, as you said, on one hand, it's about leverage, and it has been effective in bringing countries to the table, at least the first round. Now, the second round, as he announced new tariffs, countries instead announced retaliation. And so that just is a tit for tat, where one tariff is going up and another tariff is going up, and it's going to end up slowing down growth and costing more and having inflation spread throughout the global economy. On the revenue side, it's really very unclear, because back in Trump 1, they collected about $70 billion of tariffs from China, or on the tariffs that were collected from the imports on China. 62 billion of that went to farmers to compensate them for the retaliation that China imposed on them. So there was very little that actually went to the U.S. Treasury.
So based on that, I'm just wondering, when you get the reciprocal tariffs that are going to be coming down, what part of that is legit? That, like, look, you tax our stuff more, I'm going to tax your stuff more, and that's a legitimate sort of change in our trade policy versus stuff that's a little over the top. How do you break that down?
Well, the tariffs were negotiated as part of a big package over the years. So we got some more in services, for example. They got more in tariffs. Our average applied tariff is about 3%. Their average applied tariff, the rest of the world, is about 7%. There are some outstanding tariffs where one could say, why does Europe have a 10% tariff on our cars? We only have a 2.5% tariff on their cars, and that's one of the tariffs that the president has focused on. It would be awfully easy for the Europeans to drop that tariff and just take that issue off the table. But to raise tariffs and then to find ourselves in this retaliatory cycle runs a real risk that we're going to see higher inflation, impact on workers and incomes here in the United States, and on inflation around the world, as well as on growth.
You point out the retaliatory cycle, and I guess that brings to mind questions of credibility here, because we already have trade deals with a lot of countries. We had a USMCA, which was the successor to NAFTA, and all this seems to be put aside by the president whenever he invokes any kind of special emergency powers or any kind of sections under some trade codes. So at what point are countries not at all confident that they can move forward with anything that has been agreed on up until this point?
I think there's a real issue around that. I think the fact that we've been so willing to ignore existing commitments we've made to other countries, they're all very surprised. Canada, in particular, is wondering, what did they do wrong? Right? What can they do to get out of the doghouse here? It's not really a fentanyl and migrant issue on our northern border, and so they're trying to figure out what they can do to get back in good stead. Having not solved that problem, they've now imposed tariffs on our products, and are talking about restricting various access to important minerals or commodities that we need from Canada.
So what is your panic level, I guess? Like, you've been doing this a long time. How nervous are you for the state of global trade, and how much do you think we can rationalize here?
You know, the good news is the U.S. economy is less dependent on trade than a lot of economies. Okay. So and we've shown amazing resilience through the COVID, through the global financial crisis.
And growth is still good.
And growth is still good. We're the prettiest house on an ugly block. Our economy is growing well. So for the U.S., I'm not particularly concerned in the short run. I think if the tariffs go into place and the retaliation goes into place, and we see this kind of escalation, we're going to see upward pressure for consumers. This administration has said they're not interested in consumer prices. This is not about window fan or ceiling fans and how cheap they are for Americans. But more than that, we're going to see impact on producers, on workers who are dependent on inputs for their products. So last time we saw steel tariffs go into effect, the number of workers in the steel sector before the tariffs went into effect and now, exactly the same. But when the tariffs went into effect, it killed 75,000 jobs in other sectors that depended on steel as an import. And that's not always appreciated. So the overall impact, I think, is one that we should be concerned about.
Yeah, you have to look at the broader ecosystem. So as we look ahead to some big meetings that President Trump will have, he's supposed to meet with Putin tomorrow, speaking with him. And of course, he has said that he's going to meet with Xi Jinping, the leader of China, sometime soon, in the not too distant future, I believe was the exact quote. What are you anticipating to come out of this Putin conversation? What would be a good news story for the U.S.?
Well, a good news story would be Russia agreeing to a ceasefire in Ukraine. I don't expect that to happen. I expect instead Putin to say, oh, sure, we're in favor of a ceasefire under the following conditions. And the conditions are such that the war will continue until they feel like they've gained everything they can possibly gain. Question will be, at what point does President Trump say that Putin is not really interested in a ceasefire and begins to take further action to put pressure on him the way he's put pressure on President Zelensky? With President Xi, I think the real question is, the president's been very moderate in his rhetoric about China. He's been far more harsh on Canada than he has on China since the election and since the inauguration. And there's talk about him wanting to do a grand bargain with President Xi. Does that grand bargain have something to do with Taiwan? Is it just related to trade? Does it deal with issues around the South China Sea? These are all open questions. But he clearly believes he's got a good relationship with President Xi, that he can cut a deal, the ultimate deal, and that hopefully that those relationships will continue.
What does Xi have that Trump wants?
Well, you know, it's a good question. He wants China to buy more of our things. His phase one trade deal during the first term focused a lot on commodities, on LNG, on soybeans, corn, things of that sort. You know, we're more than a commodity producer. And so the question is, can he get China to actually buy more of our products and balance the relationship in that way? Then the concern is what other issues are thrown in, including around Taiwan, which is what China very much wants to focus on.
Michael Froman, always a pleasure. Thank you so much for coming in today.
Thanks for having me.
Michael Froman is president at the Council on Foreign Relations. Now, coming up, we're going to bring you the top three, where we focus in on the top three movers and shakers at the center of the day's biggest stories. This is The Close on Bloomberg. America's most prestigious colleges are rushing to the bond market at the fastest pace on record. We're talking about Harvard, University of Pennsylvania, and Stanford. They're all selling bonds, all within a span of weeks, and against this backdrop of tax and funding threats. Bloomberg's Danielle Moran, who is the team leader for our muni bonds coverage, joins us now. And so, Danielle, when it comes to why colleges are issuing so much debt, is it because they need to or because they can?
Right now, it's because they can. So colleges are issuing debt for a variety of reasons. One is simply there's been a backlog of projects. So during COVID, campuses weren't really sure what was going to happen, so they put a lot of infrastructure projects on hold. They say we'll get to it later. And then they did for a little bit, but then rates rose really quickly in 2022 and 23, so they put their borrowing plans on hold, and now they're starting to come back to market. Rates have stabilized, they think they're going to be higher for longer, and they're more comfortable issuing debt. So we saw that a little bit last year, and even in the last couple of weeks. Another factor which is causing the decisions now is especially colleges and universities don't really know what's going to happen in Washington. So they are trying to get ahead of any policy or tax law changes that might increase their borrowing costs later in the year. So they want to get to market. They have the appetite from investors. So if they can do it, they are doing it.
So what kind of colleges and universities? Are these like really expensive high-end ones? Or are these like the small private guys that are already struggling with enrollment? Like who's issuing?
I mean, really, we're seeing the gamut. So the high-end ones, the prestigious ones, Harvard has come to market, Princeton, UPenn, Smith College, all women's school up in Massachusetts. I'm a Patriot League grad, and Colgate University is coming, I think, tomorrow. So it's really a group of colleges, and we're also seeing some a little further down the credit spectrum, but it's being dominated by the big guys that you would know.
What are the schools saying about this this rush to tap the bond market?
Right now, they're saying this is normal course of business. This is for projects that we had coming.
Except it's not, though. When you look at the numbers, it's not.
So some of them are saying this is part of our normal plans. There's nothing to see here. But you really have to consider the broader environment when you look at this stuff. And that is that there's a lot of changes going on. And so they are taking advantage of an attractive rate picture, attractive investor demand, and they're coming to market. We've heard from bankers and some investors that they're accelerating sales. So that's what we think is going on.
But then at the same time, you get the news today that Harvard is going to offer free college tuition if you make under $200,000. Under $100,000, you get room and board for free. It's like, I know they had that huge endowment, but can they afford that part? Like they have to go to the bond market to issue money for that.
So Harvard is the wealthiest U.S. college. They have a massive endowment, and that allows them to be able to do these things like provide all of this financial aid for students. So right now they can afford it. They have a very low interest cost. Harvard is AAA rated, so they're able to come to the bond market. We don't expect them to issue debt to be able to afford that type of policy, and it does really advance the amount of students that they're able to help out.
Yeah, that's their competitive advantage, the fact that they have that $53 billion endowment and can make decisions like that. All right, Bloomberg's Danielle Moran, thank you so much.
Of course.
Really appreciate it. All right, let's go now to the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Chuck Schumer, the Senate Democratic leader. He's putting his book tour on hold, citing security concerns. Now, this book tour was originally scheduled for this week, but Chuck Schumer is kind of busy right now, fending off heavy backlash from both the party and his base over his handling of the government funding fight in Congress. Basically, the Senate Democrats caved in and said, okay, we're going to sign the bill, and there's no government shutdown. And some parts of his party not too happy with that.
Not too happy. Did you see over the weekend MSNBC host Simone Sanders Townsend announced live on the show that she's no longer with the Democratic Party, that she's now an independent because of exactly that, because she perceives that Chuck Schumer caved to President Trump. So there you go.
Well, he was in an impossible situation. Nothing was going to come out where
nothing good was going to happen either way. All right, I am watching the two astronauts in space, Butch Wilmore and Suni Williams. Supposedly, they're going to return to Earth after spending over 9 months stranded in space. Their mission was supposed to only last 8 days, but was extended due to several technical issues with their original spacecraft. I'd be the kind of person where I'd be like, I don't believe it till I literally put my feet on Earth, because at that point, when you have 9 months, it keeps getting pushed out.
I know. Wow, look at that. I mean, I'd be so thrilled if I were them, and their family members certainly. All right, so fingers crossed that this actually comes through in every way.
We will see.
All right. as for number 3, I'm watching Apple TV's award-winning show Ted Lasso. So I guess the fictional TV characters are last third person.
I think that is totally okay.
It's been officially renewed for a 4th season. The show's future was really up in the air after the season 3 finale, which aired back in 2023. Jason Sudeikis, who also serves as the executive producer, will return to the show. The rest of the cast is yet to be announced. Not clear whether it's going to be in the UK or whether it's going to be back in the US, because at the end of season 3, he moved back to the US.
Wait, I thought it was going to be a women's soccer team.
Yes, but is he going to do that in the US or is he going to do that in the UK?
Oh, I got the impression it was the UK, but I could be wrong. But the most important part of this is we don't know if Hannah Waddingham, is that what her name is going to be in the show.
I know.
I would be so crushed if she wasn't, but I don't know how you bring her back. Like, it's one of those things where, like, it comes on.
Maybe she buys a women's team too.
Maybe.
Right?
Or
and Jamie Tart plays a role here too as well. We clearly have watched too many episodes of Ted Lasso.
But, like, the thing is, you want it to be good, and if it's not good, if it's like, oh, you guys really should have ended it in the 3rd season, I hate that.
The season 3 was already a little bit rocky.
Dicey, agreed, right? And then they kind of wrapped it up in that really nice bow, and like, you want to unravel the bow, and then everything falls out.
Yeah,
we're clearly watching it though. If people have been tuned out at this point.
All right, coming up, we're going to speak with Bill George. He's the former CEO of Medtronic and an executive fellow at Harvard Business School about his outlook on CEO sentiment since President Trump's return to the Oval Office. This is The Close on Bloomberg. All right, let's take a look at how markets closed on the day, because the S&P 500 extended its recovery from that drop into a correction last week. You could see it closing up about 0.2%, 56.75 is the close, and with it, the VIX declines to about 20.5. Not much movement in the bond market, at least on the day, with the 10-year just below 4.3%. Of course, we do have the FOMC beginning its 2-day meeting tomorrow, and the Fed is not expected to do anything when it comes to interest rates, preferring instead to wait and see and hear more about how President Trump's tariff policies and other decisions shake out. And you're seeing gold, however, continue to climb. It is now above that $3,000 level, so closing above that level. It's been poking its head above $3,000 for the last 2 trading sessions. It's a comment on just how much investors continue to seek safe havens, even as the market recovers. All right, let's talk about CEO sentiment. Under the second Trump administration, it's falling. The Business Roundtable's latest survey results from the top CEOs shows that their expectations of the U.S. economy have dipped due to the volatility and policy shifts since President Trump's return to office. Joining me now to discuss is Bill George. Bill is the former CEO of Medtronic, and he is an executive fellow at Harvard Business School. Bill, it is really good to see you, and I appreciate your joining us today. We know that President Trump met with the Business Roundtable in recent days, and I guess my question to you is, how much are executives really sharing their frustration with him behind closed doors, out of the public's eye?
I think they're all afraid to share their frustrations behind when you're behind closed doors without the president there. I think you're hearing a lot of deep concern. We've gone from euphoria at one of those meetings in December that I was at to now being in meetings with CEOs, deep concern and confusion. And their view today is the economy has turned down, inflation has gone up, interest rates are not going anywhere. They're going to stay where they are, or could even get worse. And a lot of them think we're going into a recession. And so everything is on hold. All their investments are on hold. Their M&A deals are on hold. They're not going to put money into new factories until they get some clarity over tariffs. And when it changes twice in one day or every week, they have a new number. And they're scared of these things working through the supply chains. That's important to understand. Mm-hmm. Steel and aluminum tariffs are going to work their way through all the machinery, all the automobiles, aircraft, everything, and they're very concerned about that coming through.
So they don't
just starting to see them. Go ahead.
No. So they don't want to say anything because they don't want to be targeted in any way or punished in any way. Yet the few times that CEOs have spoken up or at least lobbied for change, I think about the automakers, for instance, Jim Farley over at Ford talking about the devastation that tariffs would have on the auto industry. It has come to something, right? Because it was carved out from the tariffs.
Yeah, I think they should speak up, and they have the power to do it. Another group that's really deeply concerned are the retailers, food retailers. With the inflation that's coming, a lot of their products come from Mexico and Canada. And of course, the apparel retailers, like the Walmarts and the Targets, they're going to see like 90% comes from Asia, and they're very concerned about the portion that comes from China. So yeah, big concern on the part of all these CEOs. And yeah, I think some of them should speak up, but maybe they'll speak as a group. But they are concerned about retribution. There's real fear of that.
There's real fear of that, and at least when the stock market was in a correction, those fears start to really grow and amplify. I wonder to what extent we'll have to see a really big decline in the stock market for executives to decide that it's worth it to speak up. Do you have a number in mind in terms of how much the stock market needs to fall for them to decide, hey, it's worth raising my hand and saying, you know what, we're kind of concerned?
Anything into the teens, yeah, there's deep concern. I mean, heard Brian Cornell at Target speak out, Corey Berry at Best Buy, who are heavy importers of goods, and there is no supply chain for television sets in the United States. There's no supply chain for a lot of the T-shirts and things and casual clothes that a Target or a Walmart offers. So, yeah, but I think when it gets into the teens, myself, you'll start hearing they'll certainly speak out of association, but I think you'll hear a lot more individual or maybe more trips to Mar-a-Lago, but to try to cut a deal. But that's the problem, is there's too much of these individual deals. And even Tim Cook, take that as an example. He offered Trump this tremendous win that had been in the works for 4 years and took advantage of the CHIPS Act to build factories in the U.S. and to source his chips through TSMC in Arizona. And the next day he gets attacked for diversity. So I think he probably feels like I can't win no matter what I do. He handled it well, but so you see this concern, and you hear it much more in private. You're not hearing it in public yet.
Yeah, absolutely. Is there a bigger role for the lobbying groups, the trade groups to play then, where they would be protecting the individual CEOs or the individual companies, but they can at least collectively say something about how, this is affecting our business in this specific way and quantify that?
Absolutely. And I think the trade groups must do that. They have to represent, and they don't have too much to be concerned about. There won't be individual retribution against a whole industry. So I think they're concerned about. By the way, another group that's really concerned, I was with a whole group of life science CEOs last week. They're deeply concerned about the cuts from NIH into the research budgets. That's going to affect them directly this year. And what people are having to adapt to is hundreds of millions of dollars of profit going out the door this year. This is not next year. This is right now. And so the life science CEOs are very concerned about the cuts from NIH and the impact on their business right now. And because they're involved in so many of these research projects, and many of them are NIH funded. So it spreads wide across industry. So you've got all the way from retail to auto, all the heavy industry. Another one that's
Yes. We got to leave it there. Thank you so much. I appreciate your time. Bill George is Executive Fellow at Harvard Business School, telling us a little bit more about how CEOs certainly worried about how the trade picture is going to shape up. As we mentioned, markets closed the day in the green, not at the highs, but good enough for a 0.2% advance. This is The Close on Bloomberg. Good news for retail traders. Robinhood unveiling a new hub for users to bet on the likelihood of certain event outcomes, whether it's political, like the November presidential election, or sports-related, like the upcoming March Madness tournament. Paige Smith, Bloomberg News consumer finance reporter, joins us now. So when it comes to these kinds of prediction markets, who regulates this? And did Robinhood get everyone to, cross the T's and dot the I's?
Well, that's a good question, especially because this is not Robinhood's first go at sports event contracts or giving retail traders the ability to basically wager on the outcome of sports events. So the entity that regulates this is the CFTC out of DC. And basically what we know right now is that the CFTC essentially has engaged with Robinhood and like I said, Robinhood rolled out the sports event contracts for ahead of the Super Bowl and then really quickly rescinded that offering for retail traders, essentially citing the idea that the CFTC had been in conversations with the regulator, and then those conversations changed in some way. So we now have indication that, based on the statement, that they have continued to be in talks with the CFTC, and now they're rolling out these offerings for retail traders ahead of March Madness. So something must be going on.
But they didn't tell us what's different from the time that they asked for the Super Bowl wagers.
They did not go into that detail just yet.
Okay, well, we'll continue to watch this space. Paige, really appreciate it. Thank you so much for setting that up for us. Paige Smith of Bloomberg News. Now, speaking of March Madness and the NCAA tournament, our next guest writes that the odds of an exciting Cinderella run has never felt more remote, and NBA legend Steph Curry wants to do something about it. So the Golden State Warrior is going to serve as the assistant general manager for basketball at Davidson College, his alma mater, and create this 8-figure fund to recruit players. Adam Minter of Bloomberg Opinion, who covers the business of sports, joins us now. So remind us, Adam, of Steph's own role in the NCAA tournament, because he played a pretty instrumental role here.
Yes, he did. In 2008, he led one of the great Cinderella runs in NCAA history, taking Davidson College, which was a number 10 seed, student body of 2,000, all the way to the Elite Eight. And he came within 2 points of taking them to the Final Four against Kansas. So he sort of represents what a Cinderella is in the NCAA tournament. And he'd like to ensure, with this 8-figure fund, that Davidson is able to do it again, that it's able to recruit the players, and more importantly, not lose players to these bigger programs that have the ability to pay now, 6-7 figures for stars.
But you say, Adam, that it's almost impossible for a small school to repeat this feat because of changes in the business of college athletics, specifically name, image, and likeness, and the role of collectives. So is it a case where just the strong get stronger?
In many ways, it is. In April, a court is going to approve what's called the House settlement, which will allow schools to spend up to $20.5 million on players, given share revenue from NIL. And with the transfer portal, meaning players can transfer as much as they want between schools, you essentially have free agency for college basketball players, college athletes in general. So, with that, it makes it almost impossible for a small school like Davidson, which simply doesn't have the alumni base, it doesn't have the institutional support, it doesn't have the stadiums necessary to pay the big money to keep these players. So that makes it hard for them to hold on to players who they brought in, have developed and seasoned, who might lead them on a Cinderella run. They can't hold on to them anymore. Those players are going to go and transfer to places that give them better economic opportunities.
Right. So even if they do have that player, they have that for 1 year, and then they lose them very quickly to the stronger schools that have a lot more resources. Adam, thank you so much. Adam Minter of Bloomberg Opinion, who covers the business of sports for us. Now let's move along here and talk a little bit more about this, because joining us now for more on the name, image, and likeness industry is Steve Denton. He is CEO of Opendorse, which is one of the leading NIL platforms on the market. Stephen, thank you so much for joining us. I guess before we get to what Opendorse does, I want you to comment on what Adam was just telling us. What do you make of Steph Curry's efforts to help a small school like Davidson to fend off the Dukes and the Auburns and the Houstons in recruiting talent? Could this work, or is he kind of working against gravity here?
I think it helps, obviously, right? You've got this GM role that is being implemented in many universities and colleges these days, as the dollars get bigger and more professionals get associated with recruiting, retaining, and rewarding these athletes. So I think it's helpful. Certainly, the size of the budget is really important, and as Adam talked about, with the House settlement going to get ruled on here in April. Schools will be able to pay up to $20.5 million a year for all the athletes at the school, and not all the schools can compete at that level. So you need to pull out all the steps, and having a Steph Curry as an assistant GM is certainly one of those levers that you would want to pull.
Right, to the extent that you can. So let's talk about Opendorse, Steve. What specific services do you offer to individual athletes, to these college athletes?
Yeah, so think about Opendorse. We're the market leader in NIL. So we work with 200 universities and colleges to provide them the technology to enable their athletes to work on a marketplace where they can do deals with collectives or brands. And it also provides the reporting, the disclosures to the NCAA, the tax, and the fair market value for those deals as well. So it's an all-encompassing NIL solution that helps collectives, colleges, athletes, and brands compete in this space.
So right now that we're talking about college athletes, there's some high school athletes, some phenoms who are also able to cash in on NIL as well. What happens to college athletes once they graduate and they become professionals, albeit in perhaps development or minor leagues?
Sure. So we've got 150,000 athletes on our platform right now, but 115,000 of them are student athletes in college. We have 35,000 athletes that we work with today that have graduated. They've gone on and they're either in their professional athletic career or they went pro in something else, or they're members of the Olympic Committee. So the Olympic team. So we work with them across the entire spectrum. We have some high school athletes that are on the platform as well in the states that allow that. But you need to be 18 years or older to accept an NIL deal. So there are some regulations there. So they continue to work as they go pro or move on in their careers. We specifically focus on the college side, and like I said, there's 115,000. And I think what's interesting about that, Scarlett, is the fandom of those 115,000 athletes is about 300 million social followers on TikTok, Instagram, and other platforms.
And the fandom for female athletes in particular is pretty intense. You have some numbers here that show us that the women's basketball total social media audience is 3 times bigger than the men's. Why is that, and how do these players capitalize on that?
That's a great point. And going into the tournament, like if you look at the top 8 seeds on the women's side of the bracket and the top 8 seeds on the men's side of the bracket, on the men's side, there's only one roster that's got over 1 million followers, and that's Duke. On the women's side, you have over 6. And in fact, the average women's roster has 1.3 million Instagram followers, where the average men's roster has 450,000 followers. So I would tell you that is the great equalizer in college sports, because I think the fascinating number there is when you strip out the collective dollars and what the universities are going to pay the athletes to go there after the House settlement passes, and you just look at what brands are paying athletes in terms of being spokespersons, the women are earning 59 cents out of every dollar spent by brands that are employing or contracting these athletes as spokespeople. So I think it's the great equalizer for women in non-revenue producing sports, because they're actually out earning their male counterparts when it comes to brand dollars.
Yeah, of course. But the institutional support from the school is a whole different league entirely. Steve, you took over as CEO last July. You replaced the co-founder Blake Lawrence, who's the former University of Nebraska linebacker, who had been the face and the CEO of the company since its launch. I know you're an expert at scaling businesses in the tech space, but maybe with less experience in sports overall. I'm curious to hear what's been the biggest adjustment for you in making the transition to sports from where you were previously. What's been new for you?
Yeah, so just to be clear, Blake and Adi are still with us, right? So they're still here. They're doing great work, and Blake's getting to focus on the things that he loves to do, which is working with colleges. What the company needed was, if you think about that stat that I gave you around, 115,000 athletes with 300 million social media followers, that in itself is an advertising publisher network. And with NIL, with commercial NIL being the new battleground on the NIL side, because the schools are going to pay the athletes directly. So commercial NIL is going to be the battleground. That's where my background came in handy, and where I've been working really hard in the company, which is how do we turn that into a media network and help these athletes monetize their name, image, and likeness with brands outside of what the schools and the collectives want to pay. So that's where I've been spending my time. That's why I was attracted to the role. And candidly, it's the biggest adjustment has really been the House settlement and all the changes that are happening on the collegiate side of things. It just seems like every week there's something new going on there. That's a bit of a roller coaster, but it reminds me of the internet of 1998. It's just every day it's something new and it's chaos, but there's a lot of opportunity out there, and it's really exciting.
All right, good stuff. Steve Denton, CEO of Opendorse, thank you so much. And by the way, you can participate in this year's Bracket for a Cause for March Madness by typing in BRKT into your terminal. and clicking on the Make Your Picks function. We do have some breaking news I want to get to right now. According to President Trump, Michelle Mickey Bowman will be the Fed's new vice chair. Once again, he's saying that Michelle Mickey Bowman will be the Fed's new vice chair. I believe she is going to take over overseeing financial regulatory in the same way that Michael Barr was before he stepped down following President Trump's election. Again, President Trump saying Michelle Mickey Bowman will be the Fed's new vice chair. Now, still ahead, we're going to set you up for what you need to watch for over the next 24 hours. This is Bloomberg. Let's just recap the breaking news we told you about a little bit earlier. President Trump has tapped Michelle Bowman, the Federal Reserve Governor, to serve as the vice chair for supervision, basically overseeing the industry, Wall Street banks and smaller lenders. The expectation is she would be friendlier to the industry. We had reported that he was expected to nominate her. He has now nominated her to serve as the central bank's vice chair for supervision. And of course, this announcement comes just as the Federal Reserve begins tomorrow to start its two-day policy meeting, where it will then announce its policy decision on Wednesday. Also coming up tomorrow is NVIDIA's GPU Technology Conference, where investors are hoping a keynote speech from the CEO Jensen Huang will help squash fears that their sales boom has peaked. Shareholders will be listening carefully for updates on the Blackwell product line, as well as commentary on competitors and growth. So I want to bring in now Bloomberg's Mandeep Singh, Senior Technology Analyst here. Mandeep, this is something that NVIDIA holds all the time. Does Jensen Huang tend to say anything that moves markets at these events?
I mean, look at the CES this year. He was, quite prolific in terms of talking about newer products, humanoids, and, autonomous driving. So clearly the breadth of the event has grown over the years. And what you can expect is something similar in terms of, new product specs, really touting the lead that they have both on the training and inferencing side. AI agents has been a big theme this year. I expect NVIDIA's and especially Jensen's comments to focus a lot on that. But look, in the end, what's driving the stock is more the exposure to China and the export controls impact on that. Whatever he's going to talk about tomorrow is going to be great in terms of product enhancements and stuff like that. But I don't think he's going to address tariffs or China exposure tomorrow.
So are we going to learn anything on the Blackwell product line specifically, perhaps demand for it, take up on it?
Absolutely. I think that will be one of the key focuses. And they may introduce a variant of Blackwell just to show that they have made progress in terms of packaging more flops and really kind of offering the next version of their chip before the Rubin launch. And look, everyone realizes NVIDIA has the lead when it comes to the chip. So the question is, how much demand is there and how long can it sustain? And it looks like, going by the CapEx increments this year from the hyperscalers, the demand will be intact at least for the remainder of the year.
And what time does he begin speaking?
1 p.m. Eastern.
1 p.m. Eastern time. Okay, so plenty of time for the market to react in real time to whatever he says. Mandeep Singh, thank you so much. And of course, Mandeep will be covering for Bloomberg Intelligence as well. Just a quick check here on what else we're watching over the next 24 hours. At 8:30 a.m., we'll get housing starts, building permits, as well as the import-export price index. Also at 8:30 a.m., Canada's CPI numbers will come out. And of course, we mentioned that the Fed will begin its two-day meeting too. By the way, the MLB season also begins in Tokyo. That does it for us. Balance of Power is up next.